Welcome to Market Brief After Hours. It has been an absolutely dizzying day across global markets. We saw massive intraday swings, a complete reversal in risk sentiment, and some major developments on the geopolitical front that sent oil prices tumbling and equities surging. To make sense of this wild ride, we are going to break down the key takeaways, look at the major index movements, dive into the global reaction, and then get into the technicals of the Forex and commodities markets. Let us start right at the top with the catalyst for today's massive turnaround.
The entire tone of the market shifted on a dime following signals of a potential de-escalation in the Middle East. U.S. President Donald Trump announced via social media, and later backed it up in televised remarks, that the U.S. and Iran held productive talks. More importantly for the markets, he announced a temporary halt to planned strikes on Iranian energy infrastructure. Before that news broke, futures were pointing to some pretty heavy losses. But the moment that de-escalation was signaled, we saw a broad-based rally across risk assets. It was a classic relief rally, unwinding a lot of the defensive risk-off positioning we saw build up last week.
That relief was definitely reflected in the major U.S. indices. Let's get into those exact numbers, because the recovery from earlier weakness was striking.
Striking is the right word. The Dow Jones Industrial Average surged by 1.38%, closing at 46,208. To give some context on how volatile the session was, the Dow had a peak intraday gain of more than 1,100 points. Prior to this rebound, the index was sitting roughly 9.8% below its record high, dangerously close to correction territory. The S&P 500 followed a similar path, rising 1.15% to finish at 6,581. At its highest point today, the S&P was up more than 2.2%. This really helped stabilize the index after it had suffered a 7% pullback from its recent peak, driven largely by those earlier surging oil prices and lingering recession fears.
And the tech sector managed to shake off its recent sluggishness as well.
Exactly. The Nasdaq Composite advanced 1.38% to close at 21,947. Tech shares caught a strong bid alongside broader risk appetite. The Nasdaq had also been flirting with correction territory before today's turnaround, pressured by rising yields and all that geopolitical uncertainty. We saw major players like Nvidia and Apple post gains of more than 1%, which really supported the broader recovery. It just goes to show that when macro risks take a back seat, even temporarily, the demand for growth stocks comes rushing right back.
The catalyst for all of this was the easing of tensions surrounding energy infrastructure, which naturally means we have to talk about oil. The drop there was incredibly sharp.
It was a plunge. West Texas Intermediate fell a staggering 10.28% to $88.13 per barrel, and Brent crude dropped 10.92% to settle at $99.94. Before the de-escalation announcement, Brent had actually surged above $112. The fear was all about potential disruptions to the Strait of Hormuz, which is a critical choke point handling about 20% of global oil supply. Taking the immediate threat to that infrastructure off the table allowed supply fears to ease dramatically. However, forecasts do remain elevated. If tensions flare up again, those constrained flows could easily push prices right back up.
The timing of this news created a fascinating dynamic between the Asian and European markets. It was essentially a tale of two different time zones.
That is exactly what happened. The Asian markets were open and trading before the shift in U.S. policy tone, so they absorbed the full brunt of the earlier risk-off sentiment. The fear of stagflation driven by those initial high energy prices triggered a broad sell-off. In Japan, the Nikkei 225 dropped 3.5% to 51,515, and the Topix fell 3.4%. South Korea took a massive hit. The Kospi plunged 6.5%, which actually triggered a temporary trading halt, while the Kosdaq fell 5.6%. We also saw Hong Kong's Hang Seng lose 3.5%, China's CSI 300 declined 3.3%, and in India, the Sensex and Nifty 50 dropped 2.46% and 2.6% respectively.
But by the time the European markets were in full swing, the narrative had completely changed.
Right. Europe got to trade on the de-escalation hopes. The Eurozone's STX 50 gained 1.2%, and the Pan-European Stock 600 rose 0.6%. Looking at individual countries, Germany's DAX climbed 1.18%, adding 265 points. France's CAC 40 added 0.92%. Italy's FTSE-IM rose 0.95%, and Switzerland's SMI gained 0.56% after recovering from an early intraday low. The UK's FTSE 100 was the slight outlier, slipping 0.24% to close at 9,894. But even that was a significant recovery from earlier losses of more than 1.5%. Travel and leisure stocks led the European rebound, advancing 2.9%, while basic resources reversed a sharp early decline to trade 3.2% higher.
Before we move on to the currency markets and individual stock movers, let us take a quick break. Welcome back. Let us pivot to the Forex markets. With all this volatility, the currency pairs have been testing some major technical levels. Let us start with the euro against the dollar.
Euro USD remains under quite a bit of pressure. It closed at 1.1613, which is up 0.36% for the session, after bouncing between a high of 1.1640 and a low of 1.1485. Despite rebounding from those intraday lows, it is still struggling beneath key moving averages. The price is sitting below the 50-day Simple Moving Average, or SMA, at 1.1729, the 100-day SMA at 1.1687, and the 200-day SMA at 1.1676. The inability to reclaim that cluster of moving averages reinforces a bearish bias in the medium term. Immediate resistance is right at 1.1640, while support rests down at 1.1485, a level that has repeatedly attracted buyers.
How is the British pound holding up in comparison?
GBP USD had a stronger showing. It closed at 1.3432, up 0.69%. The pair showed a very strong intraday recovery. Technically, the outlook is a bit mixed. The price is holding marginally above the 100-day SMA at 1.3402. It is hovering right near the 200-day SMA at 1.3435, but it remains below the 50-day SMA at 1.3507. The 200-day SMA is really acting as a pivot point for direction right now, as the market tries to build a base.
And looking at the yen, we saw a bit of a pullback today.
USD JPY closed at 158.36, down 0.53%. It formed a bearish session after being rejected from near-term highs, which shows some selling pressure emerging after a really strong bullish run. But despite today's pullback, the broader uptrend is still very much intact. The price remains above the 50-day SMA at 156.52, the 100-day SMA at 158.16, and the 200-day SMA at 152.08. All of those averages continue to slope higher.
We should also touch on the precious metals because gold took a significant hit today.
Gold faced intense selling pressure, closing at $4,397, which is a drop of 2.10%. It broke decisively below both the 50-day SMA at $4,962 and the 100-day SMA at $4,586. The price is now approaching the 200-day SMA at $4,072. This is a major shift in momentum. Those 50- and 100-day averages are now acting as overhead resistance. Silver also remains in a downtrend, despite a slight positive close today, at $68.78, up 1.3%. It is still sitting below its 50-day SMA at $86.06 and its 100-day SMA at $72.79, hovering near the 200-day SMA at $56.84, which has historically been strong support.
Let us wrap up with the specific market movers. There were some massive individual stock stories today, outside of the broader macro narrative.
Absolutely. Apogee Therapeutics was a massive standout, surging 20%. They released positive Phase 2 clinical data for their atopic dermatitis treatment, and the market loved it. Palantir Technologies also had a great day, gaining 6%. Reports came out that the U.S. Department of Defense is going to adopt Palantir's Maven AI system as its primary military platform, which is a huge win for them.
On the flip side, Estée Lauder had a rough session.
They did. The cosmetics giant tumbled more than 7%, making it one of the biggest losers in the S&P 500 today. This was driven by rumors that they are in advanced talks to acquire Puig brands, and investors clearly had some reservations about the potential deal. Finally, we have to mention the airline stocks. With crude oil prices plunging the way they did, the outlook for operating margins improved instantly. United Airlines gained 4%, and Delta Airlines went up 2%.
Looking at the broader picture, we also saw U.S. Treasury yields decline as safe haven demand returned, with the 10-year yield falling more than 4 basis points to 4.348%. And in the crypto space, Bitcoin was incredibly volatile, surging above $71,000 to an intraday high of $71,806 before pulling back to around $70,680. It seems like across every asset class, investors are reacting tactically to headlines rather than committing to a long-term shift.
That is exactly the takeaway. Today's rally was driven heavily by positioning, markets unwinding those defensive trades from last week. The drop in oil provided immediate relief, but the underlying macro backdrop is still fragile. We saw U.S. construction spending fall 0.3% in January, missing expectations, and euro area consumer confidence just hit its lowest level since October 2023. So, while today was a massive green day for equities, the market remains incredibly sensitive to any changes in geopolitical developments. Volatility is elevated, and headlines are in the driver's seat.
A perfect summary of a truly historic trading session. We will be watching closely to see if this diplomatic progress holds and how the markets digest the next wave of data. If you find this useful, please follow Market Brief After Hours. See you next time.